We're now going to get involved in the accounting part of the MicroCap market. We've covered legal, and its kissing cousin is accounting when it comes to everything in the business. So the topic is MicroCaps in 2019, an accounting perspective, and the moderator returning for his 4th year moderating, so he should know what he's doing by now. Mr. Neil Levine from Friedman, LLP.
You good? So thank you, everybody, and welcome to the accounting perspective for MicroCaps in 2019. I'm honored and privileged to be here, as Shelley said, for my 4th year moderating here with my esteemed panel. I will give each of my panelists a chance to introduce themselves and tell themselves a little bit about their firms. And first, I'll just introduce myself. I'm Neil Levine. I'm the co-chair of the SEC practice at Friedman, LLP. We're ranked number 15 in the number of registrants we have with domestic and a large international presence. So we are one of the premier accounting firms in the microcap space. No one's too large or too small. And with that, I'm going to turn it over to Corey Fischer from Weinberg, and he could tell a little bit about himself.
Hi, I'm Corey Fischer from Weinberg & Company. I'm a managing partner for the firm. We're located in Los Angeles. Our firm specializes in auditing public companies, particularly small cap public companies. Been doing it for a long time. Previously, I was with some of the national firms. I've also been a CFO for some listed public companies, so I kind of had broad exposure to both sides.
Thanks, Corey. I'm David Grossman. I'm a partner with Marcum. I lead the audit practice in the Houston office. We have over 30 offices in the U.S. and about 10 internationally, which consists of over 2,000 professionals. On the public company side of things, we have over 200 registrants that we audit, so we have quite a bit of experience in the public company space.
Great, thank you. Amanda Schlank, Audit Director with SingerLewak. We're a regional-based firm out of California. One office in Denver, about 350 full-service public accounting firm. Really client-focused, deadline-driven, so anytime you need anything related to transactional services, audit, tax, we're really there to just help and get the job done in a timely manner.
Good afternoon. My name is Shaji, Varghese. Thank you. Wow. It's amazing, okay?
Shaj, pull the microphone.
Put it back?
Yeah. We can't hear you.
Oh, you can't hear me. Oh, all right, sorry. I'm a partner at Friedman, LLP. Prior to joining Friedman about 5-6 months ago, I was a partner for about 15 years with a large international accounting firm. So I've done public companies, large 404 filers, all the way to really small cap companies. My specialty area is life sciences, technology companies. We do some foreign filers, and we're looking at some cannabis companies. So we're expanding our practice, and as Neil said, we're growing, and we're looking to grow. So this is our practice. We love it.
Thank you, guys. So let's start the discussion off with David. David, I noticed in the program there's a bunch of private companies here that are thinking about going public in the audience, and maybe you want to talk a little bit about best practices. How do you go public? And I would like our panelists, if when David's done speaking, they can jump in if they'd like to add anything that they would like to add. Go ahead.
Sure, thanks, Neil. Basically, there's 4 ways to go public. There's the traditional IPO. There's an IPO's an initial public offering. There's also reverse merger that we heard a little bit about earlier today. There's also the SPAC, which is a special purpose acquisition company. We also heard a little bit about SPACs and CPCs earlier today. And then there's also a way of going public by raising money privately and then taking the company public without raising money. And then let me talk about some of the accounting issues, if you will, among these 4 ways of going public. On the traditional IPO, one of the hurdles that we see quite a bit is for a private company, a lot of times they account for things more on a cash basis. Well, the SEC wants full financial statements in accordance with U.S. generally accepted accounting principles. U.S. GAAP requires accrual basis. And so that's one of the issues that we see quite a bit, that the financial statements are on full accrual basis. And so that's one of the first accounting issues. And then a lot of times what we'll see is the company wants to go public. At the same time, they want to combine with other businesses. When you have a business combination, you most likely will need other financial statements of those acquired businesses to also be audited. So that's another consideration. Another thing outside of the financial statements that a private company wants to start to consider, I think we've heard a little bit about earlier today as well, is kind of the key performance indicators. You want to start thinking about those from a quantitative basis so that you can start reporting those key performance indicators to the public so that you can indicate to the public what those are so they know that you're on track. When you're on track, that's when your stock price takes care of itself. There may be some unique technical accounting issues related to your industry, depending on which industry you're operating in as a private company, that need to be considered. And then also, if there's a business combination of some sort, you'll need to consider pro forma information related to any of those business combinations. On the reverse merger side of things, what's unique there is the legal acquiree is designated as the accounting acquirer. And so you have to think about things a little bit differently from a legal perspective versus an accounting perspective. And what a reverse merger is, you basically have a public shell that legally acquires a private company that's an operating business, but the operating business becomes essentially the accounting acquirer because the shareholders of the private company end up having majority control of the company. They probably have control, governance control through the executive officers and the board of directors. And so what happens in a reverse merger is that the financial statements of the private company essentially become the historical financial statements for the SEC registrant. And so that's a little bit uniqueness on the reverse merger side of things. In a reverse merger, the way the SEC looks at that is it's essentially a recapitalization of the private company. And so you have to go through those mechanics to adopt the capitalization of the public company for the private company on a go-forward basis. And then in the SPAC world, there's some unique things related to the SPAC that kind of go away once you do the business combination, but it's some things for a private company to at least understand so that when you're looking at a SPAC set of financials, you understand what those things are. A couple things are the deferred offering costs. You'll see assets on the books for the deferred offering costs are those costs that the SPAC company incurs in order to raise the money that's included in the SPAC. And then once they raise the money in the SPAC, those common shares are redeemable, and so they sit kind of in this weird world for non-accountants. They're essentially temporary equity. So they don't sit in the equity section of a balance sheet. And so it's just, as a private company, you need to understand that it's not permanent equity, and some of that equity can go away because of the voting rights that the SPAC shareholders have related to any acquisition that management puts forward to the shareholders. And then the last piece is the deferred acquisition costs. So the SPAC company incurs some acquisition costs that get deferred until either the acquisition happens or an acquisition fails, and then those costs get written off.
Neil, can I just make one comment? And not accounting, by the way, because I had an example of a client that reached out to me during Thanksgiving, and he wanted to go public, and he said, can we get done by December 31st? I said, no way you're going to get done because you don't have proper people in place. To go public, besides all the accounting stuff that David talked about, you need to have proper people in place. You need to have a board. You need to have a CFO in place, right investment banker. I mean, you just can't go public just like that. It's a process, and it takes a bit of time. I just want to make sure that people understood that part of it.
So to piggyback with that, Shaji, Corey, what have you seen with some of these private companies that they say, like Shaji says, hey, we want to go public, but they really don't have the records, they don't have the financial statements. So what have you been, I know what we've been, what have you been recommending to these private companies who have a dream to go public and they don't have the CFO that's qualified within their organization?
Well, if you're planning on going public, you need to bring in all the resources that you need to go public, and that certainly means bringing in a skilled and qualified accounting group. You cannot possibly make it through that process without those type of people. The world of accounting is way too complicated and complex. Certainly if you're going public. In fact, I just read something from Ernst & Young, and they said one of the biggest problems for companies going public is filing incomplete or poorly worded registration statements or offering memorandums. So you got to bring those people in place. And absolutely, there's too many complexities, especially if you're a small public company. The accounting is way more complicated than you ever imagined, especially if you get involved in certain types of lower tier equity type deals where convertible notes that have conversion prices that reset, where you're issuing warrants that have resettable exercise prices. They just open up a whole can of worms, and you have to have the expertise in-house to address those, and they need to be addressed properly in your financial statements. You need to understand how do you account for shares issued for services and shares issued for financing transactions. Most companies in the microcap world use their shares as a currency. And if you're a public company, you have a trading price, so you can at least value those shares based upon that trading price. But if you're not public, the question is, how do you value those shares? And it's not easy. I mean, the AICPA has put out a hierarchy of how you value those shares, and the first level would be the trading price, which you don't have. Second thing would be like cash type of transaction. If you issued shares for cash in the past, you could use that valuation. Of either of those two, then you got to go to some sort of independent valuation, which gets very, very tricky and difficult to really get to the right answer. And then if you're doing an IPO where there's a trading, a target price out there, then the SEC might say, well, you got to use that price. So those raise a lot of issues for companies going public. Companies going public, the other thing is they got to make sure that what they say in the front of the book matches what's in the financial statements, and particularly the SEC is very focused now on segment disclosures, which means that if you, in your financial statements and footnotes, you have to break out your lines of businesses. And most companies don't really want to do that because it's cumbersome, it's more time consuming. So they try not to make those disclosures, but yet in the front of the book, in their narratives, they talk about all these different products they have, different product lines, different divisions. And then the SEC looks in the financial statements, and there's no segment disclosures. So that causes problems. So there's a lot of issues out there that we could spend all day talking about.
What about hiring outside consultants just to come in to prepare financial statements for a company? Because obviously you can't be independent, audit your own work. Have you had much success with these outsourced consulting firms that a private company out here would think about hiring?
There are some very good consultants out there, but if you have the dream of going public and that's your plan, you need to have an in-house CFO that could oversee the accounting and the closing process. And then it's a good idea to have these types of consultants out there to consult on various different types of accounting issues, like this complicated debt and equity, because a normal CFO is not going to have that expertise. But yeah, there's some very good CFOs, consultants. Like think there's a couple of them probably walking around here that I think know the industry, but they got to know public accounting.
Great.
Excuse me, public companies.
Thank you. So I'm going to jump over to Amanda for a second. Amanda, what are the auditors and audit committees doing to get ready for the new critical audit matters, and what will have to be disclosed in their filings? And I'll let Shaji jump in after you answer about the critical matters, and then tell us about the increased focus with the audit committees and their responsibilities.
Yeah, definitely. So in 2017, the PCAOB came out with a new standard that now is requiring auditors to include within their audit reports or their audit opinions what we call CAMs, or critical audit matters, and it's probably the most pervasive change that we've seen to auditors' reports in the last decade. And audit committees and companies may think to themselves, well, this is the auditor's report. I don't draft this. Why is it important to me? But definitely to the contrary, because what's going to take place is a critical audit matter is anything that really has a lot of subjectivity or estimation to it. And what's going to be important from an audit committee and company perspective is that they're talking early on to the auditors to ensure what they're going to disclose within their auditor's report, which obviously is going to be included within the 10K, is consistent with the disclosures that the company has as well. So this becomes effective for large accelerated public filers for fiscal years ending after June 15th, 2019, and then for all other reporting companies after December 15th, 2020. So a lot of auditors are going through what they're calling like a dry run in the first year, where they're drafting up what they anticipate putting in to the audit report. And audit committees and companies are speaking early on with their auditors just to make sure that everyone is on the same page, because when it comes down to it and we're trying to get a 10K filed, the last thing you want to have is potential questions and issues with discrepancies between what's disclosed in the auditor report and what's disclosed within the 10K, because the SEC is definitely going to be looking at what those disclosures are to, again, make sure there's consistency surrounding it. So definitely recommend that if you're involved in an audit committee or company, that you're discussing as early on as possible with your auditors.
Thanks, Amanda. And Shaji, you want to talk about I have something that happened today, and I want to maybe have a little.
With the audit committee or CAM?
Somebody called me, and they were on the board, and there is fraud in the company, and they said to me, Neil, can I get some records? So I'd like you, when you talk about the responsibilities of a director and the board, if someone's on a board and they're suspecting something, what kind of rights might they have?
Yep. So absolutely, we'll talk about that in a second. Let me just add on to what Amanda said about CAM, by the way. If you look at the international reports, if you look at foreign filers, there is the foreign filer, the opinion for public companies, it says there is a key audit matters, by the way. So this is there, so you could follow it. Unfortunately, the U.S., the SEC is behind the game, so to speak, because the auditors don't like it. They don't want to put a lot of stuff out there. The company doesn't like it. But it's very important, and for audit committees, what they ought to do now, I think, is they should start doing that. They should start talking to the auditors now. Mm-hmm. They should say, hey, tell me, what is this going to look like? Let's talk about it. I don't want to find out in 2020 that you have this thing and all of a sudden the whole thing's blown up, right? So you want to address that now. That's my personal opinion anyway.
Definitely.
So going back to my to audit committee, and I'll get to your comments in a sec. When I look at audit committee, audit committee, as you know, for all pubcos, all public companies, it's mandated by SEC to have audit committee, and they're supposed to be, you at least need to have one financial expert. And what is the role of an audit committee, right? The role of an audit committee, if you look at the item 10 in the 10K, it says the audit committee reviewed the financials with management. They reviewed the financials with the auditors. They made sure the auditors were independent. They also made sure that they recommended the financial statements to be included in the 10K. So that's what's mandated at a minimum by the SEC in the 10K. And of course, if you look at the audit committee's role, their role is a monitoring and oversight role, right? So what did they do? They oversight on the financial reporting, internal control and financial reporting, which will address your question on the fraud part of it. There's a risk oversight as it relates to fraud, oversight of the auditors, us, that's their responsibility, ethics and compliance, again, going back to what Neil was saying, oversight of internal audit. Now, what is internal audit's role? Their role, if there is internal audit, if there is no internal audit, how is a company adhering to the 404A piece of it, not the B, where the auditors have to opine on internal control for financial reporting, but the management's assessment of controls. Do they have documents in place saying they're checking and balancing, making sure that they don't have anything that's suspect? They're saying, the CEO of the company, the CFO of the company is saying that we have looked at our controls and we're comfortable with the controls. So that's essential. Who is supposed to be overseeing that? The audit committee. If they're not doing that, they're missing their responsibilities. They're also responsible for the interaction with management and board. And as far as they're
So
concerned,
if I'm the CEO,
Yep,
am I
sure.
the boss of the company?
you are. You are,
But I'm being, who's controlling the company?
Yeah. So it's an interesting question when it comes to smaller public company, right? Because technically, a CEO of a company feels, oh, it's my baby, I can do whatever I want. But when you're a public company, it's a different animal. You are the boss, but not really the boss. There is a governance, there's a board now. So you have to listen to the board. I mean, we have examples of clients that we can talk about where the CEO really got upset at the board and the audit committee because they put checks and balances with him. He just couldn't go out and do whatever he was doing as a private company. So to answer your question, the CEO is responsible for running the business, right, operational, but the audit committee has the oversight, right? Primarily financial, right? Financial reporting part of it. But of course, as part of that, you have, the question about fraud, ethics, compliance, all of that stuff is under the purview of the audit committee. So he has to report to the audit committee.
So the question I had today, real life, can a board member or a director get internal records and look at the accounting, if you know? Or if any of my panelists.
The board, I mean, listen, you would normally go through an audit committee, right? Because that's their purview. The audit committee is responsible for the accounting function, the accounting group. So if they suspect something, they feel like there is an issue, they should speak to the audit committee. Absolutely. And then through the audit committee, they should be able to find or get whatever they want.
Okay, got it.
That's
We got to move on.
Anyway, let me.
No, we got to move on. All right, so you
I
can talk all
I
day.
can talk
So
forever, exactly. All right.
we're going to have good questions.
The answer is yes. I've been through it, had to sue the company. Director can get access to any record if he has reason.
Okay.
And Neil, by the way, with respect to the audit committee, by the way. Okay.
All right, so
I could write a book later.
Shelley had a good panel this morning at 12:30 talking about MicroCaps, Australia or Canada. So let's go to David. So we had this panel this morning, and there's people that trade from, like I said, Canada, Australia. What are the issues with cross-border listings for other countries? Do they need PCAOB auditors in Australia to come here and list on OTC? So what can you tell us about that?
Sure. Thanks, Neil. Probably the biggest issue is here in the U.S., we still follow U.S. generally accepted accounting principles. Most of the rest of the world is following international accounting standards or international financial reporting standards, IAS or IFRS. And so that's one of the biggest issues from an accounting perspective when you look at cross-border listings. Fortunately, a few years ago, I forget which year it was, the SEC finally adopted the rule that foreign private issuers that file financial statements under IFRS no longer have to do a reconciliation between IFRS and US GAAP. Previously, anything that was filed with the SEC that was not under US GAAP, you were required to do a reconciliation between whatever GAAP you were following and US GAAP. Now, foreign private issuers that follow IFRS, that reconciliation is no longer required. And fortunately, most of the rest of the world is following IFRS or some modified IFRS. One of the examples of something that's very different from US GAAP and IFRS is, let's take intangibles. Under US GAAP, if you take an impairment on U.S. intangibles, you can never recover that impairment. Under IFRS, you may have the ability to recover that. So there is a difference between U.S. GAAP and IFRS in that regard, and there are other differences between the two accounting standards. As we develop more and more accounting standards over time, they're trying to reconcile and get them as close as possible, but we still have differences. And so that's one of the considerations that you need to take in mind depending on which way you're cross-bordering, if you're originating in Australia and coming here to the U.S. or originating here in the U.S. and going to Australia. Most of the major countries now accept the other countries' accounting standards with maybe some minor modifications. So that's helpful. As far as reporting, since we had the folks from Australia speak this morning, the reporting requirement in Australia is half yearly and annual financial statements, which is different than what's going on here in the U.S., at least currently. Here in the U.S., you have to do annual financial statements that are audited and quarterly statements that are reviewed. And there has been some discussion at the SEC that the SEC may change that. But that's another consideration, that you have different reporting requirements during the year between the different countries.
Okay, thanks, David. So let's talk about something that's near and dear to my heart, Corey. So, with the SEC regulatory, whatever's happening there, internal controls, what have you seen with enforcement, not following rules? Unfortunately, some of my past colleagues, accountants and lawyers, give us the flavor of what's going on in the world of the SEC.
As it relates to internal controls. Well, I think there was a big surprise this year. I think many companies and management and board understood that with the passage of the Sarbanes-Oxley Act back in 2002 or 2004, whenever it was, that companies had to adopt and maintain and implement a system of internal controls, financial disclosure controls, and had to have those controls, if they met a certain size, those controls had to be audited. And if there were weaknesses, those weaknesses had to be disclosed in the financial statements or in the narratives, item 9. What companies didn't understand was that they had to fix those controls. So for years, many companies have disclosed the fact that they had all these controls, weaknesses, and really didn't do anything about it. Well, come January of this year, for the first time, the SEC actually brought enforcement action against 4 companies that had repeatedly disclosed that they had weaknesses in internal controls, but never fixed them. So the SEC decided that they needed to send a message. They wanted the companies to take the responsibility, and that if they have these weaknesses, that they just disclosing them doesn't fix it. They need to get those controls fixed. So that was a big surprise this year. Secondarily, from the auditor side, the auditors, as you know, are subject to inspection by the PCAOB, who is the accounting oversight group. They come in and they look at the work that the auditors do. The last few years, the PCAOB has stepped up significantly the emphasis on testing the auditor's controls of those of our internal control testing. So there's been an increased emphasis by both the SEC and the PCAOB. So the control testing is real, and we got to get it fixed if you're a public company, and you have to take it seriously. There was maybe some relief coming in the old House. There was on the floor that they were going to try to raise the limit of the cap test from $250 million, from $75 million of unaffiliated market cap to $250 million. With the change in the Congress last year, that has kind of fallen off the table. I'm not sure if that's ever going to be brought back again, but right now, if you're a public company, if you have over $75 million unaffiliated market cap, you're going to have your controls audited. If your market cap falls below 50 million, then I think you could get an exemption and you don't have to have those controls audited. But right now, if you're within over 75 million, you have to have, not only do you have to have the controls audited, but it looks like you now have to get them fixed.
Thanks, Corey. So let's talk about when one of these microcap companies issues stock. So we've all heard the term, and it's been in the news again, cheap stock. Shaji, what can you tell us about what does cheap stock mean? You may want to talk about issuing shares to founders. Go ahead.
Yep. So let me start with an example, right? So I had a client that was a clean tech company that decided to issue tons of shares to their employees because they felt very generous. So they issued a lot of shares to the employees, and then as we were auditing it, we said, well, how did you value these? Why are they at $1 a share, while you're looking to go public at $8? So the guys, they look at the companies, look at the P&L, it's losses everywhere, the company has no value, it should be $1 a share. And they arbitrarily chose to do the $1. We disagreed, we had a valuation guy look at it, they said, no way. So we said, listen, if you're not gonna agree, we're gonna resign, and or what you could do is you could go to the SEC and bring it to them and have them rule privately. Because we don't want you to go through an IPO process, a roadshow, and then find out once the process is like almost done that your financials are completely a mess. You need to restate because your comp costs, because again, to answer your question, the cheap stock is essentially that cheap, right? You're issuing stock below fair value. That's what cheap stock is, the meaning of cheap stock is, as it relates to a public company. Now, so essentially, what you ought to do with cheap stock, if you're issuing stock to your employees or anyone really, within 12 to 18 months of going public, our suggestion as an auditor is you hire a valuation expert contemporaneously as you're issuing these stocks and make sure that you have the right value on the books.
So do we have any questions that the audience would like to ask one of our esteemed panelists?
It's a simple question. We're all in this audience, we're all public and private companies. How do we choose which accounting firm to use?
Can I answer?
Oh, I think, well, I'd like to give that a shot. So all my colleagues here are esteemed colleagues, and I will say this. Whatever firm preaches and practices a quality practice to do the right work for your client and to do the right work for the firm. If an accounting firm gets a subpoena, we're looking at $100,000 just to open it. So we don't want that kind of trouble. So Shelley, to answer your question, when you're seeking and interviewing audit firms, we know price means a lot, but I think what even trumps that is the quality of the work that we're delivering.
Shelley, I think you ought, like with anything else, right? You look to see if the guys have done what you're looking for, right? If you are a certain type of a company and the auditing firm has not done it, do you hire them? No, right? So you hire the right firm, the quality, like Neil said, and it's a chemistry also. The fee matters, I guess, to some extent.
Well, what's great about public accounting is that there's a way that you could determine the quality of the firm. We're all inspected by the PCAOB.
Right.
The PCAOB publishes the inspection reports of the firms. So you could just go look up at the PCAOB website, and you could definitively see the quality of the work of that type of firm. So it's right out there for you.
You know what's interesting? If you look at the PCAOB report for PwC, they probably have a 60% failure rate. Think about that for a sec, right? How bad is PwC? It's just sometimes it doesn't connect, right? It happens because, and I've gone to multiple inspections, and we've done great on our inspections, so I'm not even going there. But you get these auditors, PCAOB guys, who come in and ask questions that are so different. I had a situation with one of my clients, where the auditor, the person from PCAOB was somebody who was a manager at PwC before. She was a financial services person looking at a technology company. And her question was to me on an internal control for financial reporting piece of it, the 404B, her question was, do you have a hypothetical type 2 assessment of controls? I said, huh? They don't have a type 1 failure on, this is an impairment issue, on intangible. I said, they didn't fail type 1, so why would they have step 2? Excuse me, step 1, step 2. I mean, these are the questions they ask, right? And could they fail you on that? Anyway,
Yeah,
I'm just,
I think being the only woman up here, I would probably say that the prettiest one would be the accounting firm that I would necessarily go to.
I'll drop to that.
But besides that, I mean, I think it's fit. Like, it really is fit. You want to work with someone that you work well with. At the end of the day, we are independent. We are your auditors. But we also try to be an advocate and work well with the companies that we're with. It is a partnership, but obviously with the fine line of independence. So again, it's really meeting and understanding what your needs are and if the accounting firm's able to meet that. We're
Thank
all
you.
full
Lulu.
service firms here.
Introduce
I'm
your
not
friend.
Lulu, in case you can't tell.
I know who you are. Go ahead, introduce yourself.
I'm Dan Montano. I have a biopharmaceutical company. But since 1968, I've been an investment banker, venture capitalist, and started about 100 companies. And for those people in the room who understand the registration process, attorneys can fix everything in their section of the registration statement by words and contract modifications. Where you collapse is if your auditing is improper or incorrect. This is the most critical part of any registration or fundraising process. The auditor part, when it gets to the SEC, is not funny, not negotiable. And every deal I've ever seen fail at the registration side always was in the accounting auditing section. The attorneys can put in 50 more risk factors and they can word it this way and that way. They can get around most everything. But the accounting auditing is the backbreaker, and that's why you need very good auditors.
Thank you.
Eric Fleshy, Glendale Securities. What role do the auditors play in determining whether the issuer is checking or not checking the shell box on the 10Qs and the 10Ks?
Sounds like he had an issue with this.
Okay, repeat the question.
Do you audit do you actually audit whether or not they're checking the shell box or not checking the shell box, yes or no? Is that part of your audit review?
Part of the auditor's responsibility is to understand that everything outside of the financial statements, although we're not responsible for reviewing things, is to make sure that it's consistent with our knowledge. So if we see that that box is checked as a shell and we know that there's been operations, yeah, I think it would come to our attention, and I think a good auditor would raise a question. We're not lawyers. The determination of a shell is more of a legal thing, and I would push to the lawyers to come up with that determination. But again, it comes just like anything else that's in the front part of that document. We don't necessarily take responsibility for it, but we got to make sure that it's consistent with our knowledge.
Thank you, Corey.
If anybody has any more questions, I'm sure you'll be at the cocktail party tonight that you can answer and meet and greet and find
Thank
out
you.
everything you ever wanted to know.
Thank you
From
so
all of our
much.
esteemed panel. I thank you very much for joining us.